radio for a really great future. We're talking real money.
This may be an exercise in futility. Okay, it probably is an exercise in futility, but one of our goals here on Talking Real Money, the podcast, is to get you to give up some of your mistaken methods of managing money. That was about as alliterative as I can get in the morning. Wow. Because we do a lot of dumb stuff. And one of the dumb stuffs we do is we go to a broker, for example. We go to they call themselves semi-fiduciary financial advisors or whatever the heck they call themselves. And we ask them to help us make a portfolio. Well, there's another way to do it, but is it better? We're going to talk about the difference between your broker-built portfolio and your model portfolios. Modeled after what? Military aircraft?
I know which plane I'd pick. Okay, go ahead.
That's what we're going to talk about here on Talking Real Money. I'm Don McDonald in our lovely Florida studio. Of course, not venturing outside because today it will once again feel like 10-something.
No. We're not good here, as you know, above 70. So
you almost choke on the humidity. It's so thick. And Tom, though, is in the cool and lovely Bellevue studio in Washington State.
High of 65 today or something. So
seriously?
Yeah. Really
in
crazy.
June?
In June, yeah.
In June?
It used to be, by the way, when I was growing up, you hoped for a nice day by the 4th of July. That's the way it was. That's changed. Summers are now longer and hotter.
Are you saying there's global warming?
Isn't it climate change?
Oh, anyway. Climate change. Sorry, I don't want to offend
There you go.
anyone.
There goes another 5
I've just
bad
offended
reviews.
somebody. We don't even have lows of 65 until October.
Oh, God.
I mean, seriously, our lows will not be in the 60s until sometime in October or November.
We're wimps here. You know that. We would not survive. So
No, you would melt down. You would be like a little puddle of sweat.
Would be it.
In the street. Anyway, welcome to our program. We look at a lot of portfolios. Tom, more than I do. I used to look at a lot. I don't want to look at any more portfolios because you guys depress the hell out of me. If you're working with a Morgan Stanley or a Ameriprise or an LPL, or you're going to have the broker portfolio.
Yeah,
right,
let's explain
Tom?
what that is. Yeah,
what is
let's
the
talk,
broker?
The broker, because I just saw another one this week. If your portfolio looks like this, you got a broker that's running things, and it's not good. Because this is old. This is old school before they built the new school after burned down by the. This is going back. This is how they used to do it. So here's. I can immediately want to open it. It's generally 20% of the portfolios in a few individual equities.
Right. And if you're in the Seattle metropolitan area,
guess what?
Those equities are
Oh, yeah.
Starbucks, Boeing, Costco, Microsoft, and Amazon.
I almost guarantee it because you know those companies because they're 10 miles down the road. So that's generally about 20%. Then there's always this sprinkling because I think they like to make the claim, well, we use index funds too. There's always a sprinkling of passive index style funds of some kind. Always
except they're probably like a Franklin Index 500 fund at 90 basis points.
Yeah, I hope they're not Nationwide's S&P at 93 basis points. That's crazy.
I'm sorry. I should have said Nationwide,
That's
not
the new.
Franklin.
That's the new standard bearer now. So we're index fund. They should be ashamed of themselves calling it that. Anyway, then there's two other parts. Most of the time, actively managed mutual funds. You'll see them ranging from, T. Rowe Price or PIMCO, and the expense ratios are in the 70s, 80s, and 90s. They're always expensive, and these are the ones that somebody back home said, these are really the smart people. And then oftentimes you have a few individual bonds because somebody's gotten really smart about which bonds to buy. Don't use those bond funds. We know which bonds to buy because we're much smarter than that. That traditionally is a broker portfolio. And when I see it, I know right away that somebody at your local office has decided this is the way your money should be managed. It's a fascinating thing, though. The good news is, in today's world, that more and more advisors, and I'm talking about registered investment advisors, are moving to having actual model portfolios, which is, I would never hire anybody who didn't. In other words, if you walk in to see somebody here, they don't get to decide which mutual fund / index funds / stocks, et cetera, that they want to pick for you. That is done. They have portfolios to pick from, but the funds have been vetted, the management of the funds, all that stuff has been done. That is the growing part of the industry. Read with great glee, that assets following model portfolios rose to $8 trillion in April. That's up from $6.5 trillion a year earlier. How would you describe a model portfolio, Don?
Well, it's a portfolio made of little tiny plastic pieces that you snap together with glue.
You don't snap them together. You push them together.
Place them into each other's little receptacles with a little dab of glue that's making you kind of dizzy.
And that's the reason I've probably
that's why
been
they're
doing
a model
these
portfolio.
For 30 years.
Oh, no, a model portfolio. See, here's where the problem lies.
It's
a
not
model
perfect.
portfolio is so broadly defined.
Indeed. Yep.
A model portfolio is just what somebody else has said is the right way to allocate based on their beliefs.
Yep.
Often not based on anything other than what, in essence, boil down to pure hunches. Of course, they'll say there's a scientific basis thereof, but our model portfolios are based on really serious, long-term academic research and like decades and decades and decades of data that has been scrupulously vetted and peer-reviewed, so as to make it as close to the truth as we can get, knowing that there is no absolute truth in the world of money.
No.
But they're a method of assigning allocations to a broad group of people in a way that has in the past succeeded.
And it has guardrails. It doesn't wake up tomorrow morning and say, "Whoa, gold has been great. Let's jump into gold." It doesn't.
Well, and that's, it was funny because you sent me an article from Bloomberg.
Yeah.
And they asked all these experts, and it was like they're real estate, gold.
What to do with $1 million if you had $1 million today?
They don't have any kind of guardrails. They're just this is what's looked good recently. So maybe we should buy it now.
One was infrastructure with and gold too. One was real estate because that's ready to come back. Is it? I mean, you look at the value of these buildings that keeps coming down. They all had an idea. That is not a portfolio. An idea is not a portfolio. In fact, that's the exact opposite of a model. So right or wrong, Don, what you're really saying is, at least if you hire somebody that has a model portfolio, at least there's a structure.
And a model portfolio structure can be incredibly simple. It doesn't have to be complicated. You don't even need an advisor to create a model portfolio. I'll give you a perfect example. A model portfolio could be one that just emulates the global stock market, because for the global stock market, we have lots of history. And we know that had you invested in a globally diversified portfolio over the past 100 years or so, you would have made decent money. Sure, you would have lost some at times, but you would have made more at other times. And at the end of whatever period you would have had this money, as long as it was in excess of about 5 years, you would have made some money.
And when I read this article from the Wall Street Journal about more and more advisors using outsourced model portfolio, it makes me happy because at least, as I say, there's a structure, a discipline. It's silly because the old school is exactly the opposite. It picks investments. Many times it's the local guy that's doing that. It is predicting trends of some kind that are coming, just like these people said, you need to be in infrastructure, you got to be in gold, et cetera. And it sells new and exciting products. We know that people that end up buying those most of the time end up with less. A registered investment advisor, hopefully a fiduciary, is using, as you said, a model that is not predicting. It's using academic research that looks back as far as they can. It is rebalancing the portfolio, not reacting to whatever's going on in the world today that says, I got to move from here to there. And again, for most people, it allows you to stay on track. And by the way, you mentioned the fact that a global portfolio, you can buy your own model portfolios by using the global funds from Vanguard or from Dimensional or from Avantis that are really good products.
Right. And they give you at least the Avantis and the Dimensional give you an academically diverse portfolio, whereas VT, the Vanguard Total World Index, gives you the market. It's just globally diversified, but it's an index and it costs almost nothing to get into it. You also, boy, when you're dealing with the broker, we talked about the fact that some brokers have index funds in their portfolios, and we alluded to the Nationwide fund. I was just checking, and let me give you some numbers,
worst?
Tom. No, they're not the worst. They're not the worst. As a matter of fact, their own C shares of their fund. The C shares, now for those who don't know, C shares are what have been referred to as liar load funds. It means they don't charge you an upfront commission, but they do charge you a commission every year for as long as you hold the fund through the higher fee. The Nationwide
what,
S&P,
0.25% or half a
or
percent,
more,
something like that?
in this case, it's 1%.
No.
The Nationwide S&P 500 Index Class C fund, 1.24%.
Good Lord.
Principal.
Shame on them for calling that an index fund.
Well, it is an index. It's just not cheap.
But people equate index with less expensive. That's not less expensive.
No.
By
Principal
any measure.
large cap S&P 500 Class C, 1.3. DWS S&P Class C, 1.3. Invesco S&P 500. Invesco. You should be ashamed of yourself, Invesco. 1.31.
That's outrageous. How much money in that fund, I wonder?
Hold on, I can tell you. I can tell you. Because
like
remember,
that.
it's sold by brokers.
Yeah, right. They're saying, oh, we have a great index fund for you.
It's
Sure,
sold
why
by
not?
brokers.
You want to be in index funds?
1.3 billion.
Not huge,
Not huge.
but still some money. But
Federated's their 500 fund, it's called Max Cap, is 1.44. But the winner when it comes to the most egregious fees, and by the way, this is the case pretty much across the board with this company. You should look at your portfolio statement and make sure you don't have any funds from this company in yours. The RIDEX S&P 500 Class C, want to guess?
1.51.
Okay, you were so low.
I make money, but not that. What?
3.
That's their S&P 500. How much is in that fund?
Class C fund. Good news is there's only 187 million in that fund.
But that's 187 million that's paying 2% for a fund you can pay 0.003.
I know, and I guarantee the only way somebody got into this fund, the only way they got into it was to be put in it by their broker.
Yep.
There is nobody in their right mind.
We've got index funds for you. No problem.
No individual investor with a modicum of sense would ever buy that fund of their own volition.
That is horrendous. Oh, by the way, speaking of the models again, just finished the Jill bomber. That's now flying and moving on to the F-35, which is going to be a bit of a project. So we'll see.
The Jill bomber?
Yes.
It's named after Jill Biden, or
no.
Who's
This is
Jill?
Japanese
Jack and
World
Jill?
War II bomber. You can type it in. You can look it up on the internet.
Jill, Jill.
Jill. That's right.
That must have been the name we gave it.
You think? Boy,
yeah, because I am pretty sure the Japanese didn't go, oh, what a lovely
let's name
bomber.
it Jill.
Reminds me of Jill. My American girlfriend, Jill, when I was in
girl
college.
or something. Come on, really?
Yeah, I don't know.
You can type it in. Go ahead. I'll wait. Jill bomber. Type it in.
You'll
It's
wait.
there.
Oh, really? You have nowhere else to be?
No. And while I'm reading the question, you can look it up. Because Laura wrote us from Portland. Said, can you recommend a good addition or couple to my taxable brokerage account to better diversify? I'm missing an international component and wondering if I should own REITs as well. Currently 75% VTI, that's the U.S. total market, and 25% VBR. I've considered the classic Bogleheads approach, adding VX U.S., but notice there's mostly large cap stocks and not really capture total market. I considered a total market fund such as DFAW, but this would limit my ability to tax loss harvest and disqualify me from the foreign tax credit, which I think is overrated. Plus the expense ratio is a bit higher. $53,000 to invest. What do you do there with $53,000 right now in VTI and VBR?
Well, you could, to get a small bias, you could, I mean, not a small bias, a small and value bias, you could get an international fund from Avantis or DFA.
And then what I would do, by the way, I'd put a third in each one of them and call it a day.
Yeah.
A third in VTI,
I'm trying
a third
to find
in
the
VBR, and is it AVDE? I always forget the ticker for the Avantis Total International. But
I don't know. For some reason.
You're looking it up.
I'm trying, but
you're
it's
still
not,
stuck on the Jill Bomber, I guess.
I'm stuck on the Jill Bomber for some reason.
Sorry about that.
Yeah, no, it just was the Allied code name for it, so it really wasn't called the Jill Bomber.
That's what. Well, aren't we the Allied? We're calling it what we called it then. I'm not going to call it by the whatever.
You have such a home bias.
We just talked about this, right? That's fair.
Well, no, we're talking. Yeah, we did just talk about it on the.
While you're
podcast,
trying to find the ticker, I will add.
I found it. International Equity ETF, AVDE, and
I believe I just mentioned that. Yes,
it swings little. It's still large cap, but it swings smaller. And a little more value. So you could do that, actually. Looking at the portfolio, I would probably skip the Vanguard funds completely and just use that as my international because it's not a huge swing. It still has lots of large.
Okay, so what would be your? So you just split between the Avantis
US.
Total U.S. and the Total International?
Yep.
Then you don't have to do the three funds. You just do two. You do one at 60% and one at 40 then.
Yeah, and then you have your ability to do a little tax loss harvesting, and because you're an international fund, you get your foreign tax credit, which you're right is overvalued.
Overrated. Okay, so 60% in the Avantis Total U.S., 40% in the Avantis International. By the way, Laura adds in at the end of her note, thank you for the quirky commentary, Tom. I do like your dad jokes. Don? That voice. Also, Roxy is great. I'd love to hear more from her. Appreciate your help as I learn about investing. Kind of saying thank you, something nice to everybody. I like that.
Yeah, that was really nice. But didn't you just get slammed for your bad humor?
I did. No, I got slammed for not knowing the difference between a market order.
No, not that one. No, I was talking about. I thought somebody told you that you got a note about your humor.
No, I yet to see it. You can forward that on to me.
Oh, it could have been one of the. It could have been in one of the reviews on Apple Podcasts.
Well, as you know, I don't read those very often. All right, John writes us from Tumwater, Washington, right next to our Olympia, the great capital of the state of Washington. I enjoy using Bolden, former new retirement, an inexpensive retirement planner. As a former Army logistical person. I don't know how to say that.
Logician.
Is that right? Logistican.
Oh,
it doesn't sound
logician.
Logistician. Okay, I'm sorry, I'm messing that up. All right, I found it. More comments to come. I found it helpful in keeping running estimates of our retirement plan, et cetera, et cetera. I had a chance to compare the software's rate assumptions to the ones in my Vestry Retire Map in 2021. That's going back a few years when we did those retire maps, which are different. Made me curious about your software's key rate assumptions the firm is using now. All right, what he wants is a comparison between what Bolden, I forget how to pronounce it, is using and what we do.
You are just having a
I'm not doing well.
problem
I'm massacring
today,
things. You can see why I went with the Jill Bomber. Anyway, general inflation, 3.05%. Yes, I think that's accurate because if you go back to the 1930s, that's about what it's been, is about 3%. Do you agree with that, Don?
Yeah, that's about right. Yes,
okay.
That is correct.
Medical inflation rate, 4.03. Now, I think that's low.
I think that's way low based on what
we run it. It's more like
6
or 7. Yeah. So I'd say that you need to jack that up a little bit. Social Security COLA 3.05. That sounded high. I went back and looked at the last 20 years. That COLA for Social Security has been about 2.5%. I'm more comfortable. I think we used to run it at 2. I'd rather run it on that side because I think that's more accurate. What he's talking about here is and I think they're already projecting for next year at about 2.5%. I think that's what I'd look at. But here's one's fascinating. Housing appreciation rate, 3.52. Now, is that...
After inflation, that's actually a little high.
That is a little high. So, but those numbers you got aren't horrible.
They're reasonable, though.
Yeah, there's nothing wrong with that. I don't know. Carol writes us... We had a lot of questions,
wait, hold on.
Way.
I found the comment. Hold on.
Yeah, okay.
All right, we're going to get
the
to
Jill
this
Bomber
question.
comment? That's
No.
fast.
No, this is the review. This is what I just read. I thought I told you. But I guess not. This is from a guy in
Thank you for being old and forgetting. Yeah.
This is from a guy in Poulsbo.
Really? Right down the road here. Okay. Yeah.
Yeah. Yeah, he gives us 5 stars. So
Okay.
that's good.
But
you know.
then,
He says, I listen to your show daily and live on Saturdays as well. I like you guys and trust you guys, and that is such a relief to have confidence in your advice. The only time I find I have to fast forward in your show is
You're just going to say it. You may as well
is when
just say
Tom
it.
tries to be funny.
Wait, I don't really try. I just am in my mind.
Yeah. It's not funny, and it wastes so much time.
Okay. All right. Well, I'll just go with the questions. For
I'm
us today.
sorry. It makes me feel so much better because you don't read the reviews.
No, I
But
don't.
boy, so many people hate me.
Wait, did they put his phone number on there? Because I'll call him right after the show. So.
Yeah. Well, he's in Paulsbo. Just go look.
Okay. I'll go look
Just
for him.
lean
All right,
out the car. Go, Dan from
Dan,
Paulsbo. I have a
Dan.
bone to pick with you.
No more comedy. Carol writes us from Tucson, Arizona. Listen to your program today in which someone asked about CD ladders. These are certificate of deposit ladders. I was thinking this might be a good place for some dry powder, but then thought not a good idea from tax standpoint. If I take money out of a bond fund, I only pay 15% capital gains versus paying 24% on interest received. Am I missing something?
Yeah, you're missing a lot.
Yeah.
One, if you take money out of your bond fund, part of that is going to be interest that is going to be taxed at your 24% rate. Any interest coming from a bond fund is taxed at 24%, period, unless it's a tax-free bond fund, a municipal.
Well, no, but where do you get to, because that's her tax rate?
She said that's what her tax rate was.
Okay. I thought you meant
She said
for
that.
everybody. Yeah, got it.
No, she said that. She said it was her tax rate. Yeah, the capital gains, if the value of the bond fund increased, are taxed at that 15.
Yep.
But here's I want to get to the meat of the question because I like to read between the lines.
Oh, what are you getting?
What was the term she used about this kind of money? To keep my powder dry.
Yep.
Now, I am pretty sure that keeping your powder dry means you're keeping money back until it's a better time to invest.
This is a timing question is what you're
I
getting at.
believe it is truly
When
at the
they-
meat
when
of
they
it,
hit the
it's
all
a timing
clear.
question. Yeah.
Okay. Yeah.
Yeah.
No, don't do
But
that.
let me tell you, if your CDs are paying you 4% per year
Yep.
and your bond fund is paying you 4% per year, your taxes are going to be identical.
Not going to be a whole lot of difference.
Identical. So it's taxes
but
are not
the
a good
only
reason.
difference there would be the CD, you know what you're going to get paid. The bond fund, you don't. There
That
could
is
be some
correct.
variability, and you just saw it really recently in 2022. So if you really just want stability and the money is there for the short-term use, I would say a CD. If it's longer term, keeping the money, this is part of my bond part of my fixed income,
Yeah.
I would go with the bond fund.
Yeah, because the CD ladder, the lovely thing about the CD ladder, and this is what I like about them for that money you know you're going to need or you really want to keep safe, not to invest later when the market goes down, is that you know what it's going to be worth at the end of the period.
Wait, did you say
always know that.
invest
With a
when the
bond fund, you
market-
don't know it's going to fluctuate.
You said when the market goes down? No one invests when the market goes down. They invest after the market goes up.
Oh, I know, but the intent is.
Yeah,
See,
but
the
almost
intent
we
is
see the flows. It
I am
almost
going
never
to
happens.
get in after the market goes down. And here's what happens when you try to do that. It goes down and you go, oh, I'm sure glad I'm not in.
Yeah, look at that.
And then it goes down some more and you go, wow, now I'm really glad I'm not in.
I'm smart.
Then it goes down a lot and you go, oh, thank God I dodged that bullet. And then it goes up a little bit and you go, yeah, it always goes up.
It's fake.
A little.
Not going to happen.
Yeah, it's
Yep.
just, it's a head fake. And you got guys like Nouriel Rabini still in the background going,
Oh, yeah.
Depression! Depression!
Take your pill, doctor.
Yeah, so you
that
don't
was
get back
supposed-
in.
that was attempt
You
of humor.
wait until, it's been up for a year, 2, 3. Now it's up.
And then
Goes down.
kaboom. Yeah.
Yeah.
You're right. So
Don't do
be
that.
properly invested at all times. And for those of you regular listeners, you know that. Mitchell writes us from Jupiter, Florida. So is that going around like Florida? No, okay, that's
Nothing goes around Florida.
Tempe humor. Sorry.
Everybody
fast forward
lands.
there.
They don't go around. They just
They don't go
land.
around.
here.
It says, my wife and I purchased a Vanguard variable annuity in 1997
Really?
at the recommendation of an estate attorney for additional asset protection per Florida laws at the time and retirement funds. Purchased them for a total of $100,000. They were invested in Vanguard Balanced Funds. The account management was transferred to Transamerica Insurance a few years ago, although they remain in Vanguard Funds. We haven't added or subtracted from them since or changed the portfolio. They're now worth $550,000. We're retired. I'm 69. We don't anticipate ever needing this money and don't need an additional monthly income stream. They were paid with post-tax dollars, but have considerable long-term gains, that's for sure. What do you suggest doing with them?
No. They are not long-term gains. They're not. Here's the problem with bloody variable annuities. They give you something that is of negligible value, which is tax deferral on some equities. And equities generally give you tax deferral anyway until you sell them. But the good news, when you sell equities, you pay taxes at the capital gains rate, which is lower than the income rate right now. You, being in an annuity, if you took any money out, it will be taxed just like taking money out of your regular IRA.
Yep.
At your regular rate.
So his question is from Mitchell, should we just continue ignoring them and let our two children eventually split the proceeds? Thank you. Love the show. Started listening to my guru, Don McDonald, in the late 1880s on tax radio, he says.
On tax radio?
They've been around that long.
I don't know what a tax radio is.
Yeah, I was thinking attack radio. Okay, so
here's the only down. Let me just go for the up and the down. The Vanguard I just wanted you to, because you know what I don't know is what the fee structure is on the Vanguard variable.
I have no idea.
Compared with other Transamerica annuities. Let's see. Oh, here, I found it. Oh, really? Oh, okay.
How is it?
Here's the downside, and it's not a huge downside. The balanced portfolio in there costs about 20 basis points. The insurance expenses, the mortality and expense risk, and the administrative charge are 0.31 approximately.
Okay, so we're at half a percent.
So we're at about half a percentage point. That's for a variable annuity. That's not expensive.
That's cheap.
So therefore, in some cases, if you have a very expensive variable, I might say slowly bite the bullet and take it out and move it to something else. But in this case, but there's the other downside. See, there is no.
What's the other downside?
If this money was in equities in an ETF, for example, and it had grown from 100 to 500,000. And you died tomorrow and left it to your heirs,
they get the stepped-up basis.
They get the stepped-up basis. There's no such thing with a variable annuity.
So they're going to have to pay the gains on the 100 or whatever? Wow.
Yep.
So could you be charitable from them?
You could be charitable from them.
I mean, could you give the money away to somebody else?
You could, yes.
But other than that, somebody's going to pay the freight at some point at regular income tax rate is what you're saying.
Yeah. This is why I have a hard time justifying variable annuities. I just do. They don't seem to serve many useful purposes given what they cost and what the downside is. So, but again, that's water under the bridge. We shouldn't complain about things we've done in the past.
No, but the thing is, they're still being sold today. There are still people buying variable annuities for a variety of reasons. With generally cost weight, I think the average is about 2.5% a year versus half. So
that may be all in. I don't know if that's the average, but I've seen them that are in that range where they have an expensive mutual fund and high internal expenses.
Yep.
Depending on what the riders are on the policy. But the problem with most insurance investments is not that they're inherently bad; it's that they're inherently opaque and incredibly complicated. They are not designed to be easily understood. And when something is designed to be purposefully confusing, it's usually to make those selling it money at your expense somehow.
Yeah, they're designed that way.
Yeah,
and
that's my big beef with them.
No, they're sold by non-fiduciaries. So I don't think you should deal with anybody who doesn't have a requirement to act in your best interest, and they are not. So
they are not.
Fair enough. Great questions.
Dude, we came in almost at 30 minutes.
Tired. Gonna go take a nap now or something.
Tom, you should go take a vacation.
Take a vacation. Well, I'm taking a break from the vacations right now just to get my rest up for the next one. So Somebody just showed up yesterday and said, "Hey, where's your next vacation?" I'm like, "Oh, stop it. Just stop it right now." Don's always saying you're taking more vacations than anybody. Well, okay, that may be true, but still.
My wife, today we were talking about stuff. She goes, "You need to take one day during the week off."
I think she's right.
And I said, "I can't, because somebody's got to do that damn podcast every damn day."
Wait, you don't get Sunday off?
I get Sunday
I don't call
off.
you on
she
Sunday
said,
because I try to give you a break. So.
Yeah, no, she said a day in the week during the week.
Oh, yeah, that's probably true.
She
but
goes,
you're right,
you should
the way
take
it's set
off
up.
a day during the week. I said, I can't Monday because that's taking the Saturday show and turning it into the podcast.
Yep.
It's got to go to compliance. It's got to go through all the all the hoops and everything. And I go, and then Tuesday I got to do the show from Saturday for Wednesday. And then Wednesday I usually have to record with Tom.
That's
or
true.
Wednesday and Thursday I have to record with Tom.
We could just move all the recordings to Thursday and you could take Wednesday off.
And no, I said, and I think about it, the one day I could take off is probably Friday. That would be the one day.
Okay. I'm okay with that.
And by the way, I wanted to let everybody know, just a little programming note. I've decided, because of the way I have to submit all of these shows to
Is this something you should run by me first before you just make a decision?
To Appella's compliance department.
Oh, okay.
So I had talked to you about this a long time ago.
Oh, okay.
And you may have noticed that I used to do a show on every holiday. But because of the way the scheduling works and the office is closed, so what I've decided to do to make this work, and you'll notice, is that on market holidays,
of which there are 7 a year or something,
7 or 8,
yeah,
and these are when Appella's office is closed on market holidays.
Mm-hmm.
I am not doing a podcast.
What?
I know, which means I'm not doing one on Juneteenth.
Well, this is going to air after Juneteenth, right?
This will air after. Oh, yeah.
Well,
which means I did not do one on Juneteenth.
That's why I never talk about dates on this because I never know when they actually
or the
air.
4th of July. I'm either not
that
doing one.
That one has not come yet. Okay. That's a Friday this year. So, and by the way, you're welcome to come over for the barbecue that day.
Sure, I'll just make a $1,500 flight out there for a barbecue.
Absolutely. I tell you what, it's going to be worth it.
Sure, because I'm like you. I'm rich. I can afford a lot of vacations.
And you can see how many fingers I end up with after that. So that's kind of fun.
Yeah. Just keep that one you use all the time on the road. Just make sure you don't use it. Don't use that one. You need that one.
That's what I do need for my own mental well-being.
The other day, a guy cut me off.
And you did nothing.
I honked because he cut me off by like inches, and I went because I thought he was going to hit me. And he sticks his hand out the window with his finger, and I'm going,
wait a minute.
Dude, you cut me off.
And then you gave me the...
And then you flipped me off.
You're a bad person. Did I mention that?
That is unreasonable. And then I kind of yelled something, and my wife goes, "You've got to control your temper when you're driving." I said, You don't drive with Tom then. Apparently, you haven't driven with Tom. If
no
you think
one drives with Tom.
You should hear Tom on the 405.
Yeah, no one. Well, actually, the only people that drive with me now are my grandsons, and I have to be on my better behavior with them.
You put headphones on them. Here, kids, watch a video on the iPad.
I'll be right with you.
Exactly. You're going to buy the Vision Pros. It'll be worth it just to protect their little eyes and ears.
Yeah.
All right.
Fair
we got to go.
We do.
Send us questions. We love your questions. Lots coming in. Thank you. You can send them in at talkingrealmoney.com on the contact form. If you want to talk to us.
Yeah.
If you want to talk to us on the weekends, well, every Saturday, Tom and I, we just working our little fingers to the bone. Not this finger, just other fingers. And you can call us on Saturdays at 855-935-TALK, 855-935-8255. Call us at 3 p.m. on Saturdays, 3 to 5. And then if you want to meet with Tom, and only Tom, because you know what? You don't want to meet with those other advisors. You just want to waste Tom's time looking at your broker sold portfolio. Just go to talkingrealmoney.com and click on the Meet an Advisor button. It's free. It's easy. And I have never known Tom to try to pressure someone into being a client. I don't think any of our advisors do that.
They're
or
not
Tom would
supposed to.
come down like a ton of bricks.
Then let me
on
know.
him.
Yeah, if you feel like you have been, let me know.
Yeah, let him know. You'll ruin someone else's career, but let him know. You'll destroy another human being's life,
I'll
but
call
let him
him
know.
the Jill Bomber on him, but still, yeah.
The Jill Bomber. Was there a Jack Bomber?
No, there was not.
Really?
But there are other American nicknamed Japanese bombers, yes.
Okay, good to know. I mean, the Zero? That was their name, wasn't it?
That was their name. That's correct.
Okay.
Yeah.
All right, ladies and gentlemen, before this deteriorates anymore.
Any further?
Yeah. We're going to go. Thanks for being there with us as we are What are we doing? Come on, you
All
know what we're
the
doing.
time.
We're
Yeah.
doing it. We're come on, say it with me. Talking real money. He's not good at this.
I'm sorry.
Not good.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.